I am Dr. V. Shantamina, Assistant Professor of Commerce, V. Vani College for Women, Virudhunagar. Today, we are going to see about the fourth head of income, that is income from capital gains. First, what is capital gain? Profits or gains arising from the transfer of a capital asset made in a previous year or taxable as capital gain under the head income from capital gains. But there are certain conditions. What are those conditions? First, there must be a capital asset. Second one, assessee should transfer the capital asset. Transfer of capital asset should take place during the previous year only. There should be gain or loss on account of such transfer of capital assets. So there are four conditions. First condition is there must be a capital asset. Second one, the capital asset should transfer to any other persons. Third one is the asset should be the assessee should be the owner of the capital asset. We must earn some capital gain or loss from this transfer of capital asset. Next, what is capital asset? Section 2, subsection 14 of the Income Tax Act defines capital asset as property of any kind. It may be fixed, circulating, movable, immovable, tangible or intangible, whether or not connected with business or profession. There are some exclusions to this capital asset. What are those? First one is stock in trade. Second one, personal effects of the assessee, that is the personal use excluding jewellery, costly stones, silver, gold, etc. If we transfer these jewels, stones, etc., it is included in the capital asset. Third one is agriculture land in a rural area, that is an area with population more than 10,000. Next one is 6.5 gold bonds 1977 or 7% gold bonds 1980 or National Defence Fund 1980 issued by the central government. Special bearer bonds 1991 issued by the central government. Gold deposit bonds issued under Capital Deposit Scheme 2000. These assets are excluded from the term capital asset. Then next we are going to see about kinds of capital assets. There are two kinds of capital assets. What are those? Number one is short-term capital asset and number two, long-term capital asset. First, what is short-term capital asset? It means a capital asset held by an assessee for not more than 36 months, that is 3 years, immediately preceding the date of its transfer is called short-term capital asset. In other words, in case of shares, bonds, etc., we should held the asset below 1 year. It is also called short-term capital asset. Here there are some capital assets. Number one, quoted or unquoted equity or preference shares of a company, quoted in quoted securities, quoted or unquoted units of UTI, quoted or unquoted units of mutual funds, quoted or unquoted zero coupon bonds. These assets should held not more than 12 months, that is 1 year, by the assessee. Next one is long-term capital asset. If we held the asset below 36 months means it is short term. In other words, if an assessee held an asset more than 36 months, that is above 3 years, is called long-term capital asset. In case of shares, it is held for more than 1 year. First one is capital asset and its type. Next, very important one, the capital asset should be transferred by the assessee. So what is transfer? Transfer of capital asset includes sale. If we sell one asset to others, it is included in the transfer. Second one, exchange of asset. Third one, relinquishment of asset, that is surrender of an asset to other persons is also included in the transfer. Next one is compulsory acquisition of asset. Sometimes our assets are compulsorily acquired by central government. For example, central government purchase our asset nearby roads for four-way track means it is also called transfer. Then extinguishment of any right of an asset, that is reducing any right of an asset, is also called transfer. The definition of transfer is inclusive, thus transfer include only above 5 ways. That is, what are those ways? Sale, exchange, relinquishment, extinguishment of rights, compulsory acquisition. So, in other words, transfer can take place only on these 5 ways. If there is any other way where an asset is given to others, such as by way of gift, inheritance, etc., it will not be termed as or treated as transfer. Then, what is capital asset? We already saw. Next, what is transfer also? We saw. Then, next, we will see about how will we compute capital gain or loss from the transfer of capital asset. First, computation of short-term capital gain or loss. First, we have to take sale proceeds. From the sale proceeds, we have to deduct 3 points. Number 1 is cost of acquisition. Number 2, cost of improvement. And number 3, selling expenses. So, we have to add all the 3, that is cost of acquisition, cost of improvement and selling expenses. Add all these and put it in the outer column. Then less from the sale proceeds, we have to arrive short-term capital gain or capital loss. One example, Mr. X purchased a house for rupees 15 lakhs in 15/7/2022. He constructed first floor in the month of October 2023 for rupees 6 lakhs. Due to some unavoidable circumstances, he sold the house on 23/12/2023 for rupees 30 lakhs. Here, we purchased the house in the year 2022 and sold the house in the year 2023. So, we held the house only for 1 year and remaining months. So, below 3 years. So, it is treated as short-term capital asset. It is clear? Then, we also paid rupees 30,000 as commission for selling the property, that is our selling expenses. See the solution. Sale proceeds, that is we sold the house for 30 lakhs. So, sale proceeds is 30 lakhs. What is our cost of acquisition? We purchased the house for 15 lakhs. So, here we put 15 lakhs. Then, we construct one additional building, additional floor for rupees 6 lakhs and we paid rupees 30,000 selling expenses. We add all the three items and put it in the outer column. The remaining 8,70,000 is our short-term capital gain. It's clear? Then, next one, computation of long-term capital gain. First, same procedure. First one, we have to take the sale proceeds amount. From the sale proceeds, same 3 points, but one additional word, that is indexed cost of acquisition, indexed cost of improvement, and the third one is also the same one, selling expenses. What is the indexed? That means we hear from our grandparents that we purchase 1 gram gold, 1 sovereign of gold for 100 rupees. Our mothers also told, at the time of my marriage, 1 sovereign of gold is for 10,000. But what is the present situation? 1 sovereign of gold is more than rupees 50,000. That amount we purchase at the time of 90s, 80s should be converted to the nearest year's amount. That is called indexed cost. First, what is indexed cost of improvement and how will you calculate? The formula for calculating indexed cost of improvement is our cost of improvement. That is, if we spend rupees 1 lakh for construct a first floor, that construction cost, that is cost of improvement, into CII, that is cost inflation index for the year in which the asset is sold, divided by cost inflation index in which the improvement is take place. Then, how will you compute the cost of indexed cost of acquisition? That is cost of acquisition, our purchase price, into CII for the year in which the asset is sold, divided by CII for the year, that is cost inflation index for the year in which the asset is purchased. Then, one very important point, if we spend any improvements before 1/4/2000 means it should be ignored, completely ignore that expense. At the same time, the cost of acquisition before 2001-2, because we have cost inflation index from the assessment year 2001-2. In that case, how will you purchase the house in the year 1980s, 1990s? In that case, how will you calculate cost of acquisition? That is equal to purchase price or fair market value on 1/4/2021. So the fair market value of the property also given in the problem. So we should compare the fair market value with the purchase price, then compare these two amount, then take whichever is more. So it is clear? Then one problem for the computation of long-term capital gain. Mr. Y purchases a house property in the year 1998 for rupees 1 lakh. He constructs a first floor in the year 1999 for rupees 5 lakhs. So the houses purchased before 2001. So the fair market value also considered. What is our fair market value? 4 lakhs. So the fair market value of the house on 1/4/2001 is 4 lakhs. It is also given in the problem. He construct the second floor in the year 2014 to 15. First floor was constructed in the year 1999. It should be completely ignored because it is taken before the year 2001. So that improvement should be ignored. But this second floor construction is included in the problem for computation of long-term capital gain. Right. Then he sold the house for rupees 25 lakhs on 12/12/2023. That is the previous year. We sold the property for rupees 25 lakhs. Right. So Mr. Y is the owner of the capital asset. So he transferred the asset, that is he sold the asset to someone, and the capital asset is held for more than 3 years because he purchased the house in the year 1998 and sold the house in the year 2023. So it is a long-term capital asset. So how will you compute the capital gain or loss? Here is the solution. First, we have to take sale proceeds. So the sale proceeds in the problem is 25 lakhs. So first we put the amount from the sale proceeds. First we have to deduct indexed cost of acquisition. The capital asset is purchased before the year 2001. So we should consider the two amounts, that is purchase price and fair market value, whichever is more. Here 1 lakh or 4 lakh, whichever is more. 4 lakh is more. So we have to put 4 lakhs into the year in which the asset is sold is 23-24. So for the CII, that is cost inflation index for the year is 348 divided by the asset is purchased before 2001. So the cost inflation for the year 2001 is taken. So below rupees 100. So we multiply this amount, we got 13,92,000. Then indexed cost of improvement. First construction is taken in the year 2000. It should be ignored. Second floor construction was in the year 2014. So 2,40,000 into 348. That is the year CII, that is cost inflation index for the year in which the asset is sold is 348 divided by improvement CII for the year 2013 to 14, that is 240. We got the amount 3,48,000. Next one is selling expenses. We did in this problem we didn't have any selling expenses, so it is nil. We add all the three amounts and put it in the outer column. We got the long-term capital gain, that is rupees 7,60,000. So from this video we understand what is capital asset, what is transfer of capital asset, how will you calculate income from both short-term and long-term capital asset. Thank you.